Good morning, everybody. Welcome back to the Schwab YouTube coaching channel for the Wednesday edition of Trader Talk in today's market. I'm your host, Kevin Horner. I'm joining you all from a beautiful, sunny Denver, Colorado. I'm glad you're all with me this morning. We've got plenty to get to. As always, we are going to take some time to review the major indices today. We're going to spend some time looking at a little bit of the macro view as well and dive into a lot of stocks in the news today. I am joined today on this solo session by my friend and fellow Schwab coach, Barb Armstrong, there in the chat. Please say hey to Barb. She'll answer comments and questions that I'm unable to get to, but as always, I try to keep a close eye on what's happening in the chat. A lot of the time, it's a lot of banter between you all. You know, the community here on the channel is fantastic. If this is your first time here, please feel welcomed and comfortable to utilize that chat, both with your counterparts in the discussion here, but also with me. So if you have specifics, I will try to address them as I can. If you're not already doing so, follow Barb and me on X. We're available there individually. Barb Armstrong CS, Kevin Horner CS, and you can also probably find us on LinkedIn as well. We'd appreciate a follow in all of the socials where you can reach us there. So with that, let's move to our disclosures, and then we'll dive in to our conversation topics for the day. So first of all, remember, everything we cover for you today should be considered informational and educational only. We do not make recommendations nor endorsements for any specific approach to trading the market here. We will use technical analysis, though. We do so and review the market. We talk about concepts and strategies traders may be utilizing themselves, but ultimately it's your decision to what extent you incorporate technical analysis. What we encourage you to do is think of technical analysis merely as one of your decision-making puzzle pieces, and then in working through those key details for yourself. Of course, it is very important that we individually define our process, know what it is that's going to give you reasons to be a buyer or a seller. So if technical analysis fits into that, just make sure that it is only one key component of that process, not the entirety of it. Now, if you are joining us for the first time today, be aware we do follow a top-down approach, an agenda here that takes us through the broadest indices. So we start with the S&P 500. We'll work our way through the NASDAQ 100, the Russell 2000. Of course, we'll hit up the semiconductor side of things as well, and then move into sectors before stocks in the news. And so the stocks in the news portion we usually hit in that final third of the class here today. So, and last note, if you are new, we would appreciate a follow here on the Schwab YouTube channel called Trader Talks, a great way to stay apprised of all we offer. Remember, we get started here at market open every day, Monday through Friday, and we carry that all the way through market close, usually till around 4:45 p.m. Eastern, daily live content for you each day of the week. So with that, let's take a look at how we are starting the day today here in the SPX. Now, yesterday was a bit of an uncomfortable day for a lot of traders, right? We had a pretty good sell-off in the morning. I'm going to zoom into just the last few months here, basically year to date, essentially, and you'll notice that we got a pretty healthy tail down here. So what did we learn yesterday? Well, we learned that selling is continuing to be bought up. I'm going to take us to our hourly chart here in the SPX, and I'm going to zoom in just to what's been going on since the bottom here in March. And this is a 50-period simple moving average. And one of the details about technical analysis that we need to be reminded of from time to time is that what we do and take in the way of our daily look at a chart like the SPX, we can apply to our intra-period charts as well. So here, looking at the bottoming action of the S&P in March, we recaptured this 50, in this case, hourly moving average and held it all the while. We've had a couple of very minimal tests where we pull back to horizontal support as we test the moving average here. Yesterday's low came in concert right on the money with that same 50-hour moving average. And so the trend of the last 5.5 to 6 weeks is bullish. I don't think that's a shock to any of you, but if you're looking for ways to manage your trend a little more tightly, a little more fine, then you can do so on intra-period charts. And it's not to suggest that this is the only process, but what we learn from our intra-period charts can be very helpful along the way. We're looking for things that are different from what has been happening here. So what has been happening? Well, pullbacks to the 50-hour moving average are being bought up and leading to new highs. And so yesterday's pullback did not currently lead to new highs. We're waiting to see, can we get through that 74.30 above? Of course, 74.30 represents essentially the highest we've seen the SPX in all time. So if we can pop through there, obviously, I think we would consider that to be more bullishness there if we can get through 74.29, 74.30. So this is again, for those of you who are short term. Now, if we go back, let's go actually carry this to the weekly. Now on the weekly chart here, notice this again is the 50-week moving average now. I'm going to change this though. We are on a 10-year chart here, 10-year weekly, and I'm just going to change from the 50 to the 100, and now you're looking at a 100-week simple moving average. This is also quite instructive for us, everybody. A couple of key details that stand out to me. Number one is that last low we made. How close was that last low that we made here to tagging the prior peak? This is such a common occurrence. It does not, should not be shocking to us technicians that a level that was considered resistance, once broken, can act as support. And at the beginning of 25, when we underwent our tariff tantrum in March, April of that window, yeah, we came down and tested that exact same level, worked our way on a weekly basis intra-week through the 100-week moving average to the downside, but it led to buyers coming in. I find that to be quite instructive as well. And now we've got a very, no longer gentle upslope to the 100-week moving average. As you can see, it's continued to pick up steam here as prices continue to elevate and push us along. So by no means a bearish chart here. Everything we see in the way of the SPX remains bullish in the near term. Now, we know better than to think that that's going to continue in perpetuity, of course, but it does provide perhaps a little bit of confidence. And I think bulls are going to take yesterday's candle as exactly that, at least and until we say maybe trade through the low we made yesterday. And if we do trade through the low we made yesterday, that would be obviously on that hourly chart. If we took out that low, that's going to be standing out for us, right? And then the line I've drawn in here at 72.90 is essentially the gap zone that was created here just last week. So the gap level, for those of you who join this one frequently, you know the importance of these gaps. We work through those gaps as areas of potential support, potential resistance. In this case, this becomes a logical spot for any selling to get a bounce. As you know, yesterday we didn't get down there, but if we did take out the low of yesterday, then we could easily find ourselves drifting down to the gap ledge for a potential test. That's ultimately what we're looking for. Can we test, hold, if we get down there? Obviously, we don't know what's going to happen in this upper range here, 72.90 into that all-time high, 74.29. But, for the meantime, we're kind of sandwiched in between, and we're just waiting to see, do we get continuation or do we get pullback? For a lot of you, that 20-day moving average still too slow from a management standpoint. Notice the 10-day continues to provide support here. So if you're looking for reasons to be a seller, you don't have breakdown reasons. The reasons traders in the SPX would be looking to take profits up here would be tied to their own comfort levels. If you're a trader who likes to sell on strength, you might use what's gone on in the last week as a means of reducing position size. But if you're a trader who likes to sell on weakness, you've not been afforded many reasons to do so, because we have been above the 10-day dating back to April 1st. So here we are, 6 weeks later, running those trends, 10-day moving average has not been violated on a closing basis. So for a lot of you, that first close under the 10-day moving average might be an indication of when you would look to take some profits or reduce the size of your longs in the SPX or in SPX proxies, for example. So good trend here in the S&P. Let's move on to what's happening in the NASDAQ 100 today. NASDAQ 100, and honestly, everybody, there's not going to be a whole lot of discrepancy here, is there? This move from April has been broad-based. It's been in the NASDAQ, it's been in the Dow, it's been in the S&P, it's been in the Russell. So we're going to say a lot of the same things here. So I'm not going to dawdle on it too long. What we can see, more of the same. Huge tail yesterday. This one was a little more significant. We did test the high of this gap in here, so that's kind of interesting. We did buy up the gap, so we know that bulls stepped in and supported price here. We can also see that we're pretty well elevated against the 20-day once more. Maybe consider utilizing that 10-day moving average. Again, April 1st, it was recaptured and held every day since. So if you're looking for a reason to do something different, you don't as of yet have it. Again, it's our job as traders to define our comfort, our tolerance for risk, know when we're going to take action. The challenge to the trader right now is we are moving into week 6 of this fantastic rally, this fantastic trend, and this starts to happen for us as traders. We start to feel as though every move lower is immediately going to be bought up, and that's going to change at some time, but we just don't know when. So the most important thing that we traders can do is understand where it is we will make decisions. Where will I move to more cash? Where will I build that cash? Where will I take profits? How long can I stick with these trades? I'm not telling you that 10-day is the most important thing for traders, because many of you are going to be far more comfortable with a wider time frame. You're going to like that 20-day moving average, and you're going to be less concerned about any give back. Some of you might prefer the 50-day moving average. My point isn't to tell you that I know the most important, but what I do know that is most important is for each of us to define that process for ourselves. Know where it is that you have comfort and where you don't, right? So if you can define that for yourself, hopefully that'll aid you in making decisions along the way that keep you comfortable, and hopefully that comfort leads to you maintaining positions longer in the midst of these rallies. We have a good one underway right now, but do not be misled by the idea that this is only going to go higher. It certainly feels like that at this moment, but let's make sure that we take advantage of our opportunities where provided. I'm moving into the hourly bars here once more. We're going to highlight the same thing we just saw with the SPX. It's a 50-hour moving average. Boy, does it look consistent in both the S&P and the NASDAQ 100 here. So not a lot of complaints about what we're getting out of the NASDAQ 100. Okay, now we are showing some weakness this morning in our small cap. So we're off about 1/3%, or 2/3, excuse me. And here the difference, we've got recently right to new highs and a pullback to the 20-day. So what's interesting to me is the price movement in the Russell has been a little bit less aggressive, but equally instructive. Just looking at what we've done here, we've built this breakout and then consolidated. So we had this kind of nice, very speedy V. We broke through, consolidated for 2+ weeks, and let that 20-day moving average get caught up with price action. So now what we've got is a little bit of confluence of valuation here, or a little bit of confluence at price level at that 2,800 ledge, which looks very insightful for us, doesn't it? Notice we've got the 20-day right there to 2,800. You've got a round figure of 2,800, and you have former resistance, now potential support. So if I color that properly, we'll make that a green line. This now becomes an area for potential support and a break under which traders would then maybe lighten up Russell positions or proxies for it. Now, today, are we getting weakness based on the 10-year yield? I can't say we are, because the yield is pretty flat today, and we have seen the 10-year rally into that 4.5 area, but it has not broken through it. So this might just be, brief pullback to an area of support. We could mention that the RSI is in fact moving from overbought conditions down under the 70 line. For some traders, that is a sell signal for a portion of it, but by no means does it imply reversal. There's a difference here. So we know that RSI moving from overbought to under the 70 line, so overbought above 70 in the midst of a strong uptrend. But as we move under 70 from above it, some traders will look at that as the indication of a pause in the trend. But don't look at it as the indication of a reversal, because a pause and a reversal are very different scenarios. And remember, we're in the midst of a strong uptrend. So we try to lean in to the existing trend as much as we can. So this is by no means bearish here. We may change our viewpoint with trades under the 2800 level. And again, validate that for a lot of you based on those trades on a closing basis more so than an intra-period basis. And then I wanted to see the hourly chart here on the small caps, and you can see that it's a slight bit different, right? Because we've had these moves beneath the 50-hour moving average. But the last time that we were below it, what did we do? Like I mentioned, we kind of filled that gap before we found our bounce. Okay, so are we getting rejected? Yeah, we got rejected right there today. We rallied into that 50-hour after having broken down there yesterday. So, we may have some more work to do here in the near run. But remember the importance of that green line that here on this chart is essentially the same as what we saw on the daily. So Russell hanging in, but we're coming in to an important ledge there around 2800. Let's see if we get there today. Let's see how we act if we do in fact get there. So I did want to hit that 10-year. This is what I'm talking about. It is flat now, but you'll notice as I zoom in here, we were through it. I mean, we opened higher today. So our high on the 10-year at 44.89 today, which again on the TNX:CGI quote, we just moved the decimal one spot to the left for you here. So 4.46 is the 10-year yield is how you would look at this. And of course, breaking through that 4.5 there looks like it would be a significant development. As you can see, everyone, we've been here before and it's been pushed back, and the last time we were back here was the summer of last year. So I think for a lot of traders, the significant development would be moving through 4.5 to the upside. That would be a heads up and probable headwinds against the small cap positions. That bears watching for sure. All right, now let's look at our star, everybody. Let's look at the semis. Cannot get away from these guys, everyone. A tremendous move higher. We continue to see rally here. We had a fantastic candle yesterday. Fantastic in the sense that we had a nice low test and held. So you got a lot of buying intraday off the lows. Today we opened higher and we are fading a little in the early session here. I want to call out once more the RSI in overbought conditions. Our reminder here needs to be that, hey, we can stay overbought a lot longer than you might expect. Try not to look at that as a time frame scenario, because overbought does not mean reversal. Overbought tells us that it is a healthy trend and it is a strong trend. So let's not go too far in our assertions that, hey, because it's overbought, we can't continue to move higher. That should not be the case. Let's see here. Is the 50, I'm going to get to a couple of questions here real quick. Dave is asking, is the 50-hour the daily trading hours? It is incorporating the all price action in this case. So when we're looking at the indices, the SPX, the NDX, the RUT, they don't provide aftermarket, pre-market quotes, right? So what you're getting from those are exclusively the last 50 regular or cash session hours, essentially. And again, it's not so much that 50 hours is more important than anything else. It's just tied to the fact that when we look at it on the hourly chart for the last 90 days or something like that, in this case, the last 45 days, we have seen it provide support. For a lot of us traders, it's as simple as that. We watch the prevailing trend line for entrance and participation opportunities. Pullbacks to the purple line have been chances to join in and participate in the trend. Again, at some point that's going to change, but it does not seem to be the case just yet. And so we traders, what are we doing? We're waiting for moves that can validate a breakdown. We need lower highs and lower lows. We don't have those as of yet. So keeping an eye on something like this intra-period window may make it a little easier for you to manage your daily charts a little more effectively. And that's basically what we're talking about, right? Now, there was a question here: when yields go up, equities go down. Melissa, that's kind of a little more of a relationship with regard to small caps like the Russell and the 10-year yield. So we talk about in this class the close relationship of those two. Ultimately, that is tied to the cost associated with doing business. Remember, your small cap companies, by and large, tend to carry more debt. In an elevated interest rate environment, it leads those companies to have, in some cases, struggles to continue to do the business they've been doing. Remember, if you've got debt on your books, and let's say you are coming up on a maturity window where the debt needs to be refinanced, if this was debt provided, say, 5 years ago, and now you're reaching the end of your 5-year maturity, and you had debt, debt that you're utilizing at, say, 3.5%, 4%, and now it's at 4.5% or higher. Hey, these are instances when it creates margin difficulties for those small cap companies, and those companies just tend to be more tied and to those yields, those rates, and they have a tendency to struggle with higher rate environments. Now, that can also be said about other companies in the broad indices here, but it is certainly more applicable to those small cap companies than, say, the larger ones, just due to the debt servicing that is so frequently required. Okay, so there's a look at your S&P, your NASDAQ 100, the Russell 2000, our semiconductors. We checked on yield. Let's take a look at what's going on in our Market Watch tab. So I'm going to click the Market Watch. We're going to go straight to quotes, and this is going to give us a brief look at what's happening in the way of year-to-date movement, and also a look at what's gone on in the last 5 days, the last 20 days, the last 6 months. So the big takeaway on a year-to-date basis, we knew this already. We've had a big move in energy to the upside, but you'll notice that energy is positive in all of these major time frames, right? The last week it's up, the last month it's up, the last 6 months it's up. But the big shift here has really been in technology, where we're finally kind of back on board here at up 15% year to date. And that's a big move because most of that has been made in the last 20 sessions. So let's take a look at these visually here. We're going to go back to the charts and let's just work our way down from the energy. So here's the energy chart. We had a pullback to horizontal support. This is an interesting level. Here's why. I'm going to take my Fibonacci tool and we're going to go basically to January 2nd, which is our first trading day of the year. And if we drew that to the peak of the energy rally, what we notice is that our low in this pullback came to the 50% retracement and held. Now, we don't know if that's going to stick, but traders were more than comfortable to buy that up, and they did buy it up. And if you got the low, you got a rally of about 11%. Now, it has kind of gone back and forth. We've got a lot of headline risk for energy, but we are interestingly now, below that 50-day moving average, if I was to take off the 20-day and just go exclusively with the 50 here, it'll be a little more clear. I mean, I got to be honest, everyone. I was one of those traders who looked at this and thought, boy, we're looking at 5 or 6 days over the 50-day moving average. This looked like a good validation of the trend reasserting, and then it just did not, right? And so now we've got energy back below the 50-day, trying to figure it out. I think for a lot of traders, that ledge that we created here with the low becomes a possible way to manage risk. Under that 50% retracement, the odds increase for a much deeper pullback in energy. I think a lot of traders out there believe it's going to hold up, but try not to trade what you believe, everyone. We want to trade what we see. Energy is a little weak in the last week plus, but ultimately a bullish uptrend. Okay, let's see about materials. Materials has been kind of in sideways and consolidation here. We have a level of resistance above us that we need to get through if we want more upside, and that looks pretty important. You can see that our trend in here was running strong from early December of last year all the way into late February. This was likely working with the 10-day moving average, sure enough. And so again, if you're the trader in the short run, watching these 10-day moving averages, the close beneath the 10-day becomes your first potential signal. And that is exactly what happened here in materials. Broke the 10-day and it hasn't come back even. I mean, if you sold at the 10-day breakdown level, you might be wondering about whether you should be back in if you've not put yourself back in on this pullback. This is an important spot to get back to, right? So if we can get back above this 660 level on this particular sector index, well, then you might have the opportunity for continuation here. But the reminder I wanted to offer was we were looking at that 10-day and a lot of those big indices. This is a good example of what can happen when the 10-day breaks. For a lot of traders, if you were looking at this from just this window, you'd be saying, man, I've got no concerns until all of a sudden we're below the 10-day and then thinks, okay, now we need to take action, right? This is the kind of thing we're trying to get to. And I always like to bring those instances to the table when, we're looking at it in one instance, like on the S&P, and we're watching that 10-day and it hasn't broken down. And then we take it into these other areas and we see when they do break down, why traders look to move on, right? So I do think that that's important. Okay, a couple of other key areas here, everybody. Let's move on to industrials. Industrials holding up well. Notice the 20-day in here giving support. Okay, so not as strong as you can say. Look at that RSI. It is still in bullish regime viewpoint, if you will, because as prices have meandered a little bit, we've kind of held on to the midline here, the 50 ledge approximately, which is important for the RSI in an uptrend. So we'd like to see it maintain essentially that 50 line. But we would likely violate that 50 line if we traded under horizontal support here in the neighborhood of the 50-day moving average. So we'll monitor that from an industrial standpoint. Discretionary, kind of dabbling with a possible breakout, everybody. We are at an area of all-time highs. Now, we've been rejected initially, pulled back to the 20-day moving average. Notice we got a bounce off the 20-day moving average just yesterday. We're waiting to see. But this is an important spot for a lot of short-term traders here in this particular space, everyone, because we are at the 20-day. We have been above it for the majority of this rally, and the potential exists for maybe a pullback to some horizontal support. If not the 200-day right beneath us, maybe this zone right in here, which would match up with the last low. But that's assuming that we don't maintain what we've got here going on at the 20-day. So let's keep an eye on the 20-day short term here to help us out. Okay, that's discretionary. Now, staples. All right, so why staples? Well, first of all, this is an important level because we're running ourselves into the gap zone right here, right? So we fell through this gap, and we traded almost all the way down to the 200-day moving average, but we can clearly see horizontal support coincident with that 200-day right now, right? Now, if we can get into the gap, well, then we're going to start talking about staples as a potential leader. Why is that important? Well, it probably means if staples are providing some semblance of leadership, well, then it probably means we've taken that money from other leading groups. And it could mean the rotation is underway, taking a little bit of those profits out of those long-running positions, those stocks that have been moving aggressively to the upside, your semiconductors, your memory stocks, etc. Maybe traders are taking those profits and going more toward a little bit of the value, playing that catch-up game here. Remember, we have been super strong for 5.5, 6 weeks, but we've been led by tech and by memory, and at some point that's going to lead traders to take profits and look to apply those to positions that need to play catch up. And staples could be one of those groups playing catch up. This is an important area on the staples space. Moving on to healthcare. Got a good validation of support. Now, this does not mean that this level has to maintain, but I think a lot of traders will be pleased by the fact that we held this very important level. This is a ledge of support we've maintained now for 9 months or so. Under this, things change. Do we have risk in healthcare? Sure, at least from a technical standpoint. You've got the 50 crossing the 200 to the downside as we speak. We call that, of course, the so-called death cross. But we're not going to overthink it because we have an opportunity for price action to dictate things for us. So a couple of key details here. Number one, the last time we've tested this area a couple of times, right? So here we are over the last, say, 7, 8 weeks. We tested it down here. Look at the RSI. It made a low when we made this test. But then we made a couple of new tests, and the RSI was higher. And so that tells us that the trend to the downside is not as strong as it was when we first got here. And so we call this a bullish divergence with the RSI, and it may imply for some traders that we have a good level of horizontal support. We know that it doesn't mean it has to hold up, but it does give traders a little bit more confidence. You're absolutely right there in your assertion that we have a descending triangle. We certainly do, but you'll notice that we're paused essentially at all of this stuff, right? We've got that confluence of the moving averages. We've got the downtrend line. So what's the important thing? Can we get above that confluence? Can we push healthcare into that level? And if we do get above that ledge, above that downtrend line, the next key level becomes the last highs. Can we make a higher high? Because even if we take out the trend lines, the 50-day, the 200-day, we start trading above them, that by itself becomes more of a bullish stance. But if we can't make a higher high, then it's possibly all for naught. So rallies into this ledge become important. They might be areas where traders look to take some off. But it's not a terrible chart, but we would like to see more, right? All right. Let's see, financials, a little bit of improvement, broken down trend that has since given us higher highs and higher lows. We are allowing that 50-day, notice the 50-day flattening out. So some of you traders might just manage risk against that gap zone here. So you're looking at this ledge right around, say, 840, 839, 840. We need to see this group get better in terms of trend. It isn't yet trending the way we would like it to. I mean, we got a nice pop off the bottom, but we took that pause at the 200-day, that nice flat 200-day. But nonetheless, it is an improving look at the financials. Here's a quick hit on our tech. Not much to say here, everybody. I mean, don't fight the trend is really the reminder we give because here we are in overbought conditions, which we know can persist longer than we may expect. 20-day moving average for many of you, too slow. You got to give up 369 points to the downside to be proven wrong about a trend. So not everyone's going to want to work with the 20-day as support, but the 10-day could work here as well, much like we saw in the NDX or the SOX. All right, back to all moving averages, and then our last couple here, communications. This is looking a little different because not only did it break out, it's already been thrown back for the test. And so you've got a possible support test there. And if this candle holds today, everyone, you have a possible Cahold move. Remember what that implies. Cahold, a close above the high of the low day after pulling back. And so that's what this little very brief window is, from this to the low we made yesterday. And it's too early in the day to call it this, of course, because we've only traded through the high trade of yesterday, our low day in the pullback. But if it stays like this, if that candle stays filled in and green and we close at this level, well, then we would call that a Cahold, which could be the beginning of the continuation of the short-term rally here. So you've got a gap zone in there to keep an eye on, or the lows of this last 2 weeks to keep an eye on. Some traders will use the 20-day. Visually, if I'm being perfectly honest, everyone, it kind of has the look, a little bit of a cup and handle in here, doesn't it? And then what did we get? We got the broken handle, and that's what's led to this nice little bit of bullishness. Now, if that's a valid trend, we could just measure the height of our cup, or the depth of our cup, and then you get an approximation as to where this could go. These are never guarantees to be achieved, but if they can be helpful and instructive for traders trying to set targets. So that could possibly be, for this space, a rally of communications of an additional maybe 60 to 65 points, something like that. By no means a guarantee, but something interesting in the space nonetheless. And then the last two today, utilities testing. So we had a very nice range bound move, but we've actually come down to test the 200. In fact, I could push this level down because we've tested this ledge. It looks like we're close to doing it once more. Basically consolidating in here, but the 200-day has been your participation heads up on this, on utilities. And then real estate manages to be up here as well. And the one reminder here, everyone, these don't necessarily make sense to me, meaning you got real estate trading at these levels, and utilities hanging on, doing well, looking like a potential support bounce. But the reason that I'm not confused, but I'm asking questions, I'm trying to understand it, with yields being as elevated as they are, why are we getting, and this is probably why we're getting these groups red today, but the yields are up, so they're red today, but they are in upper areas of their trend. And that to me, that implies maybe the market thinks yields are going lower. Because again, if you're looking for yield, you go to these groups, utilities that pay dividends and interest. You go to real estate investment trusts that pay dividends and interest. Not to suggest that this is recommendation or anything like that, but you would expect these groups to do well in a falling interest rate environment. And here we have, the REITs essentially at levels that we've seen only a few times in the last 4 to 5 years. Look at this range, though. If we could pop through here, this would be a significant development in the move for the REITs, for example. You're absolutely right, Beth. Yeah, utilities are certainly part of that AI discussion these days. There's no way around that. So there's been some shift, if you will. Utilities is not exclusive to rate sensitivity as much as it once was. You're absolutely right. So, and Cecil, I agree. I don't know how are rates going to go down. The story continues to be told. Traders are not positioning for rate cuts in any way. I mean, we go all the way out to December. The expectation is for no changes to policy between now and the end of the year. So, the thing that I'm reminded of, though, is we got to trade what we see, not what we think. This is what we see right now. Real estate as a sector trading it at highs of the last 4 years. All right, so that was a lot of conversation, everybody, and I told you all we were going to get to some stocks in the news today, and we're going to have to hustle to get through some of these key positions. So we were talking about staples and the potential to break out. Well, Johnson & Johnson got an upgrade today. Upgraded at Leerink to outperform on their new drug Momentum. Outperform with a new target of 265. That's up from 252. The company said they have strong new drug momentum and it will drive accelerating revenue growth and share outperformance. The pullback here, we broke the 50-day moving average, and if you were the trader who took some off on that breakdown, you were afforded a chance maybe to add at a lower level. Kind of a questionable move given this, but the low we made here, we do have a bullish divergence here. That low in the RSI was made with this low, and then we made a lower low in price. So some traders would at least use this to say, hey, we can validate that low as a way to manage risk, if nothing else. Meaning under 220 trader in the short run might choose to move on from that, right? If that were the case. But it does mean if you think that it's going back to where it was, that you have potentially proper risk versus reward on the trade. Okay, and a couple of other ones for you here today in the upgrade. How about Dow? All right, so Dow has been an improving chart. Look at the 50-day here, providing support a few different times. We've had a bull flag that broke bullishly. You had another one here that broke bullishly. We had one here that was tested a couple of times. We're back above the 50-day. So many traders watching that. Dow was upgraded to buy at Argus on oversupply relief, as well as confidence in management. That buy is from a hold, and the stock, of course, having been affected in recent quarters by oversupply, but also by the closing of the Strait of Hormuz, opportunity to build on supply pressures created by those supply chain disruptions, according to Argus. Right, and then another one on the upgrade side I wanted to get on was similar, tied to what's happening there in the Strait, Mosaic. Now, Mosaic has been in a pretty healthy downtrend here for a bit. I just applied the 200-day moving average, and a lot of you traders don't even like to look at stocks that are below their 200-day moving averages. Understandably, you're not in an uptrend. But the stock, if nothing else, I'm always giving analysts a little bit of a hard time because frequently we see they get upgrades after the stock has already started to price appreciate, change trend. Well, in this case, they're stepping in front of it. So they upgraded, that is RBC Capital upgraded Mosaic to outperform from previously at sector perform. They put a target on it at 27, which is lower by a buck from 28, but 28 is the 200-day moving average above us. The comment here, the firm believes that the depressed phosphate margins due to the Strait of Hormuz closure and the restricted sulfur supply specifically, these are unsustainable, according to RBC. While 2026 remains uncertain, RBC sees significant value in Mosaic shares and has a strong belief that phosphate margins will eventually recover, according to the analyst in their research notes. So wanted to make note of that. I wanted to give an analyst a little bit of props because I'm always pleased when they go against trend, because the analysts aren't likely caring nearly as much about price action as they are the underlying fundamentals and health of the company. And that's an area where I pay less attention, being that I'm so tied to price action here. So very helpful when a company in a downtrend gets that upgrade. At least now it's something that we can keep an eye on. We're going to look for changes to trend. And as we talked about using that 10-day moving average as an example, or the 20-day moving average as support, the exact same thing can be done as resistance. And so, we've been basically below the 20-day now since mid-March. So you're getting into that week 7, week 8 below the 20-day. For some traders, moving through the 20-day to the upside might be the opportunity that they're looking for to put on an example trade or take advantage of a potential new trend. Okay, all I was going to see if I do have to mention one final one. It's a downgrade, and it's on one of the big boys. AMD off 2.5 or 2.75% today, was downgraded at Daiwa to outperform. The stock has rallied 150%. So Daiwa downgrades the stock with a target of 500, but they doubled the price target, everybody, from 250 to 500 and downgraded. That always makes me giggle a little bit. The gap ledge that you can see drawn in with my white line becomes a possible area for support management or trend management there. The downgrade here citing valuation for the downgrade, not much more than that. So with that, everybody, we are at time. I want to thank you all for sticking with me today. So many of you who are new, really appreciate you joining today and seeing what we're all about here on the Trader Talks channel. Go ahead and subscribe to the channel. Make sure you're following Barb and me on both X and LinkedIn. On X, Kevin Horner CS, Barb Armstrong CS. And if you like this discussion, you can help us out quite a bit by hitting that thumbs up button down below for us. We get these reviewed and archived for you very shortly. So if you'd like to rewatch, you are welcome to do so from the archive at any time. Once we get it added, it'll be right at the top of the list. So with that, thank you so much for joining today. We got plenty more coming for you here today on the channel. As I mentioned, live content for you from market open past market close. Our next topic is growth and value stocks, and that'll be at the top of the next hour, 11 a.m. Eastern. Hope you all have a great rest of your Wednesday, everybody. Thank you so much for joining, and I look forward to seeing you again real soon.